Hi everyone. Okay, so let's cover exercise 6, preparing financial statements. So we're going to create a statement of income, a statement of changes in equity, and a statement of financial position for Zimmerman Electronics. I know your textbook specifically said a statement of retained earnings, and the reason they said that is that's the only section on the statement of changes in equity that really needs any explanation because it's the only part that incurred any changes for this past year. It gave you the opening retained earnings. It listed December 31st, 2011, indicating that that is the opening balance in your retained earnings for this year, because this one is for the year ended December 31st, 2012. And it indicates that they did not sell any more shares, so therefore their share capital hasn't changed. Okay. So that's why, if you're wondering why they referred to it as the statement of retained earnings. Okay, so again, for this one, and not always, as you've seen in some of the examples, not always does a company provide you with information about sales returns or sales discounts, but in this case they did. So therefore, obviously, this information is very relevant and important to, say, the VP of sales, which is why for these internal financial statements that have all the extra detail, that is why it's there, so that the managers can use these statements to be able to make financial decisions for the organization. Okay, so we have gross revenue minus sales discounts to give us our net revenue, or the actual overall revenue dollars that we had for the year after any returns and after any discounts. Okay, so then we had a cost of sales of 300,000. And if you remember, let's say that we as a company sell water bottles. Okay, so the way that the item goes from our balance sheet in our inventory to our cost of sales is when we sell that item. So every time we sell a water bottle, that water bottle comes out of our inventory and hits the cost of sales for the amount that it cost us to buy that water bottle to be able to provide it for sale to our customers. Okay, so the cost of sales was, if you look, 300,000, which is half or 50% of our net revenue. So therefore now we have our gross profit of 300,000. Okay, so now at this point, this is where we'll add in any other income that the organization has, something outside of its normal main or core operation. Okay, so if we sell water bottles, for example, then interest income isn't part of our core business. So that's why we're keeping that interest income separate from our gross sales or even our net sales. Okay, and then our gross profit completely relates to just our core business. Okay, so so this is where we add in our interest income. And then we look at distribution costs, which we could also call sales and marketing costs, or the sales and marketing department. And the distribution costs are our sales salary and our advertising expense, for total distribution costs of 150,000. Then we have our administration expenses, office salaries, lease, insurance, and depreciation. Some of you may have put lease under distribution costs. Maybe you thought that lease was leased vehicles for our sales staff. Okay, so I would not have marked that wrong. If you can justify why that lease was put under distribution costs, then it's not incorrect. Okay, I know some of these accounts, they don't give you a lot of information. And if you were actually working for an organization, you'd be able to look into the detail of what makes up that 20,000 and know what it relates to. Know whether it's an administrative expense or if it's a distribution cost, okay? So as long as you can justify why you put it under something other than administration, I would mark you correct. Okay. So then we come down a little further. We've got our total administrative expenses of 120. We have our finance costs, which is the same as interest expense. And then we have total. The total here is for 265,000. That total indicates total other income, or in this case, interest income and operating expenses, okay, and finance costs. So it would be the negative 10,000, the negative 120,000, the negative 150,000, plus your interest income of 15,000. And that gives you the negative 265,000. Okay, so then to be able to come up with the profit before tax, you take your gross profit, subtract off the 265,000 to give you your profit before tax of 35,000. Then we have income tax expense of 10,000, and we have profit for the year of 25,000. Okay, so now our next statement that we're going to look at is our statement of changes in equity. And if you remember, the profit for the year, what we used to call net income, gets linked into our statement of changes in equity. And in this case, where it is a corporation, it becomes part of the retained earnings. Okay, so moving down, we have our statement of changes in equity. And again, the only thing listed there is the retained earnings. You could have listed the share capital as well, above the retained earnings with its total. And then underneath of the retained earnings, you could have put total equity and then added those two together. That would have definitely been correct. But in this case, where they have just added in the retained earnings, we have the opening retained earnings from December 31st, 2011 for 40,000. We've brought over the profit for the year of 25,000. We've paid out dividends of 10,000 to our shareholders to kind of thank them for investing in us. So therefore, the amount from this year that we've kept is 15,000 added to the opening retained earnings gives us a closing retained earnings or retained earnings December 31st, 2012 of 55,000. So now we can take that 55,000 and bring it down and put it in on our equity section of our statement of financial position. And as you can see here, they have brought the share capital over as well, added in the retained earnings to give total equity of 70,000. Okay, so continuing on with this side of our statement of financial position, this is when we now have non-current liabilities, and the only non-current liability that they had was a mortgage of 80,000. Then we have our current liabilities. We have trade and other payables of 12,000, notes payable of 10,000 to give total current liabilities of 22,000. Add that to our non-current liability, our mortgage of 80,000. That gives us total liabilities of 102,000. And then for our total equity and liabilities, we take our equity of 70 added to our liabilities of 102, gives an ending balance on that side of the balance sheet of 172,000. Okay, so now looking at the left side of our balance sheet or statement of financial position, we have our assets. So we start with our non-current assets. We have land of 125,000, and then they're only listing buildings as the net. So they've taken the buildings at cost and subtracted off the accumulated depreciation to give us our net buildings. They're not providing that detail in these financial statements. So then we add those two together to give total non-current assets of 125,000. Then we have current assets of inventory, trade receivables, prepaid insurance, and again, that marketable securities that I mentioned in the last exercise that can very quickly be turned over into cash. And then we have cash and cash equivalents of 5,000, total current assets of 47,000, added to the the total non-current assets of 125,000 to give total assets of 172,000, which does balance our statement of financial position. Okay, so let me know if you have any questions about this exercise, and I'm more than happy to answer your questions. Thanks, everyone.